calculation, and then we will get into an example on the next slide. But before we go into the example, I'll explain this to you, then I will show you the example without the solution, and I want you to try and solve it. And then I'll show you the solution. But first, let me explain how this is done. See, let's say you're buying a stock for 100, but you're only putting $50 on the table, right? $50 loan is there by the broker. Now, if this goes up, let's say this goes to 105. So there is a $5 profit, right? But you have to pay interest on this loan. So the first thing is the interest on the borrowed amount of the funds, right, has to be deducted. So, and of course the loan has to be repaid as well. So you take the selling price. Now I'm just taking this as for one share. Of course, you can have more than one share, but whatever is the selling amount, right? So selling price into number of shares. So selling amount, sales proceeds, let's call them sales proceeds. So you take the sales proceeds and you minus first the loan amount, right? Which is what, $50, and you minus the interest. So let's say there was a $1 interest on it. Of course, that depends on what is the interest percentage. They will tell you what is the percentage of interest and you can calculate it. Let's say for simplicity's sake, it is $1. And during this time, while you were holding it, and from 100 to 105, you got, let's say, a dollar dividend on it as well. So you'll add the dividend. Again, if it's dividend per share and its number of shares, then you need to multiply that as well, right? So whatever is the dividend amount, you add that. Now this is the trickiest bit, the sales commission. There is a sales commission on buying and there is a sales commission on selling. So when we are selling it now, obviously, we're going to just minus the selling commission. Let's say there's a dollar selling commission. So you're just going to minus the selling commission, right? So how much is that now? Let's calculate. 105 is what you get when you sell this stock. Then you minus 50, which is your loan. You minus 1, which is your interest. You add 1 is the dividend income. You minus 1 for the selling commission. And let's say you're left with 54, right? Now, what is the return you've made? 54 is the ending value. What was the beginning investment and divided by the beginning investment? Now you must be thinking, yeah, of course we know what the beginning investment is. It's $50. Yes, but what about the buying commission? Because when you will go to buy this, the broker will say the position is 400. Let's say 50% is the margin, initial margin. So you put down $50. We'll give you $50. But then when you will actually go to purchase this share, there's going to be a commission on buying. Who's going to pay for that? So you need to add to your original investment. You need to add to your original investment the buying commission. Let's say that's $1. So now your starting investment is not 50. It is 51. So ending minus beginning divided by beginning will tell you the return you have made. So this is how you do the entire thing. And just to make sure you've understood the entire process, here is a question. Pause the video, try to do it, and then I'll show you the solution. Right, so hopefully you were able to do it. You're selling it for 500 shares. So you're getting $16,000. You had taken a loan of 7,500, so you got to pay that back. You have to pay the interest on the loan, right? 375. You got some dividends. That's good. You add that back. Sales commission, right? You will minus this from your sales proceeds, and this is what you're left with. So that's the ending value. Ending minus beginning divided by beginning will give you the return. So ending minus beginning is 85, and original investment is beginning is 7510. And where is this extra 10 coming from? That's the buying commission, right? And that's how you get your return. Fantastic. Now guys, that was the meat of this learning module. Just a little bit more theory and then we're done. So now to some very, very interesting theory. that how do we place orders in the stock market. Yeah, I personally really like this learning module, especially because of this orders area, because of course when you're actually trading in the market, you have to choose whether to put a limit order or a market order, right? And what does that mean? So limit order basically means that, let's say if you want to buy an app, first of all let me explain to you what an order book looks like. So first, order book. Now let's say there are buyers in the market and there are sellers in the market. We're talking about Apple stocks, let's say, right? So there will be bids, somebody who's willing to buy, right? So there'll be a bid, let's say at 99.9, then there is another bid at 99.8, another bid at 99.7. So these are people who are bidding to buy this. Then there will be asks, people who are ready to sell it and they're asking a certain price. Let's say ask is 100.01. There is another ask 100.02. There is another ask 100.03. Right? And of course, all of these are going to be for a number of shares as well, right? So they will mention, okay, this is 50 shares at this price. Somebody is willing to sell. This is like 20 shares. Let's say this is 100 shares. Similarly, let's say this is 100 shares, 50 shares, 10 shares, whatever. This entire thing is the order book, that who are the buyers available, who are the sellers available. Now, all these people, they've put in limit orders. What are all of these? These are limit orders. What does that mean? This person who's ready to buy has given the limit that 99.9 is the maximum price I'm willing to pay and I want 100 shares, right? This person has given a limit 99.8 is the maximum price I'm willing to pay, and this is for a 50 shares order. Now, obviously there is a seller, right, at 100.01, but the trade is not going to happen because the limit assigned by the buyer is lower and the limit assigned by the seller, that the minimum price they are willing to sell for is 100.01. So these are also limit orders, but sell limits, right? That the minimum, this one for their 100 shares is willing to accept a price of 100.01, but this one wants a price of 99.9. Therefore, there's not going to be any trading. So this is called a limit order, and people who place limit orders, we call them, they are making the market, right? Because this order book is basically what the market is. So they are making the market. Now somebody who comes in and places a market order, let's say I come in and I place a market order to sell 100 shares, or let's say 150 shares. Now I'm not going to mention any rate on this. I'm just saying 150 shares market order. So whatever are the, and this is for selling, so whoever are the buyers in the market up to 150 shares, so this one will be gone, this one will be gone, and I'll buy at 100 shares 99.9 and 50 shares at 99.8, and whatever will be the average, weighted average, will be my cost of selling. And these buyers are available, so I'll sell to them. Similarly, if I were putting a buy order, let's say I put a buy order, market order, so these are the sellers. It will come in and it will buy 100 at 100.01, it will buy 20 at 100.02, and the remaining 30 they will buy at 100.03 for me, the broker. So this is a market order, and people who place market orders, we call them, they are taking the market, right? They are taking the market. They are not making the market. Now, even within limit orders, if I place a limit order, let's say I place selling for 100.005, right? Less than the lowest ask. Then this I will call making a new market, right? Making a new market. And we'll talk about the types of limit orders shortly as well. Before I go into more detail, let me just cover the slides just to make sure that everybody is with me so far. So what are we talking about here? We're talking about orders, execution instructions. What are you placing orders for? Obviously, maybe a stock or an ETF like SPY, which is the ETF which tracks S&P 500, right? And there are other ETFs as well, or a bond, right? Of course, you will mention which security you want to buy or sell. Is that a ETF? Is that a stock like Apple? How many shares you want, right? Whether you want to buy or sell. This is also called the side, right? Buy or sell. So you have to mention all of this in the order. But more importantly, you have to mention whether it is a limit order or a market order. And even within that, there is a lot more information that we can give in terms of the execution instruction, validity instruction, and clearing instruction. Let me explain all of those separately one by one. Now, first of all, what is bid and ask price? If there is somebody who's willing to sell, the price they are asking for it is called the ask price. If there's somebody willing to buy, the price that which they are willing to buy, that's called the bid price. And of course, the number of shares is the bid and ask size. We already discussed what the order book is. It's made up of bid and asks, both price and size. Right? So obviously the highest bid in the market is the buyer. Let's say in our example that was 99.9 and the lowest ask was 100.01, right? So this is the current market. If somebody comes in and puts in a limit order between this, we will say, oh, they're making a new market, right? The closer or the smaller the distance between this, the more liquid the market, right? The smaller the spread, this is called the spread. The smaller it is, the more liquid the market. Because let's say for Apple, you will see that it will be very, very small. The difference between the lowest ask and the highest bid will be very small. But for thinly traded stocks, right, it will be big. So that's not very good, because that means that there's a very big difference between the lowest ask and the highest bid. It shows illiquidity of that particular security. Now, what is market orders? They will take the market, it will be executed immediately. Whatever is the best price available, you don't mention price when you're placing a market order. Whatever is available, it will take it. But that's really dangerous, because if a stock is thinly traded, there is a big difference between the ask and sell, right? So if you want to sell, you might get a very low bid, right? If you want to buy, you might get a very high ask. So that's dangerous. So not advisable to place market orders for thinly traded stocks. Better to place a limit order. But for stocks which are heavily traded, so you can place a market order. Because if you place a limit order, let's say I want to buy a stock, I think it's going to shoot up. Right now, there is a buyer at 99.9, there is a seller at 100.01. Let's say I place a buy order at 100, but it doesn't execute because the seller is at 100.01. So just because of 1 cent, I'm not able to buy, and let's say this shoots up and this goes to 200, and nobody's obviously going to sell it to me for 100. I should have placed a market order. It would have bought it at 100.01, then I would have been happy, right? So when you don't want to lose out on some quick gain, you think the stock is about to shoot, right? So you should put a market order, because limit order, the risk is that you might not get, the order might not execute if that price is not available, because you're setting a limit on that price, right? So but the risk with market order is that you could get a price which is really bad for you, especially if the stock is thinly traded. So this chart summarizes the difference between market order and limit order. Obviously, the advantage is quick execution with market order, but the price could be unfavorable, especially if the stock is thinly traded. Similarly, the advantage with limit order is you will get a predetermined price, but it might be that you might not get the order filled at all. It might be completely not filled, or maybe partially filled and partially not filled if the price is not available. Now, making a new market, if you're placing a limit order between the best bid and the best ask, right? So lowest ask, highest bid, if you place it between that, right? 100 in our example, that would be making a new market. If, let's say, for example, I'm placing, so again, with our order book, 99.9, 99.8, 99.7, 100.01, 100.02, 100.03. Now, if I'm placing, let's say, a buy order, right, and I'm putting a pretty decent price on it, let's say 100.04. So that's going to take all these guys out, right? They're all sellers. They're all asking. These are all ask prices, right? If I put a buy limit with 100.04, it will buy all of them out, given obviously that the number of shares is there. So this is called aggressively priced limit order. Or let's say if I put a sell order, with like 99.6, right, that I'm willing to sell, the minimum price I want is 99.6. So all of these buyers I will take out if I'm willing to sell enough shares to them. Behind the market is, let's say if I want to put a buy order for 99.6, then I'm behind the market. There's already people ahead of me who are willing to buy at higher prices. Or if I'm willing to sell for, let's say, 100.04, then again I am behind the market. So if I put a ask for 100.04 or a bid for 99.96, then I am behind the market. Right, now in terms of the execution, one simple way is good till cancelled, right? And we'll just see that it stays open until you cancel it yourself. Now, that's what the curriculum tells you. In reality, what happens is there's a 6-month limit on it, right? So after the 6 months, it gets cancelled on it. So it depends on brokerage to brokerage and country to country, but that's what I've seen, that there is a 6-month limit on the orders. After 6 months, they get cancelled automatically. But as far as the curriculum is concerned, what they're telling you, good till cancelled means it will stay open, that order will stay valid until you cancel it yourself, right? There is another very interesting one which we'll see on the next slide, fill or kill, right, which basically means immediate or cancel, which means either you fill it, it's completely filled, or it's killed. So we'll look at those shortly, but before that, let's have a look at these ones. All or nothing, that either the entire order is executed or nothing, right? So we don't want any kind of partial fill over here. These are really interesting, hidden orders and iceberg orders. So basically, see, what happens is sometimes we're really big players, right? I mean, think of companies like BlackRock, Vanguard. I mean, they are huge, right? Some sovereign wealth funds like the Saudi Arabian PIF or the UAE RDR, and they are trillion-dollar funds, right? So they don't want to let anybody know if they're buying or selling a certain stock, because obviously if the news gets out and that they're selling a certain stock, the price of that stock will start going down. Or if the news gets out that they're buying a certain stock, the price of that stock might start going up. So they might want to hide their orders. Now, there are two ways of hiding their orders. One, you only tell your broker that, hey, I want to sell 1 million shares of, let's say, Tesla, but don't tell anyone, slowly sell them. But then the problem with telling brokers is that you can't really trust all brokers. Some brokers do something illegal called front running. So let's say, that's illegal, obviously, right? But some people do it. And what that is that, let's say you find out that somebody wants to sell 1 million shares. Now, you know they're going to sell 1 million shares. So what you do is you sell your shares before them, right? Or let's say you know they want to buy 1 million shares. So what you would do is you will buy your shares before them. And then when they come to buy, you start raising the price and selling them at a higher price. So this is called running in front of your client's order, or front running. So if you don't even want to tell the broker what you're doing, is that you can keep your entire order hidden, and you can place what is called an iceberg order. So think of this as the ocean, and this an iceberg in the ocean, and the entire iceberg is hidden and you only see the tip of the iceberg. Now, this is done through algorithmic trading, that the computer itself is just going to feed the market little orders, right? And itself, it's going to hide the order and not even tell anyone what the entire order is. Only your computer or your algorithm is going to know it. But don't worry about that too much. This is something that is developed over level 2 and level 3 as you proceed in your CFA studies. Now, good till cancelled stays valid until you cancel it yourself. In reality, of course, it gets cancelled after 6 months approximately. But as far as the theory is concerned, good till cancel means it will stay open until you cancel it yourself, or it's filled, right? Number one. Number two, immediate of cancel or fill or kill, which means either it will be filled or it will be cancelled. Day orders will automatically cancel at the end of the day, and good on close. Now, this is, remember I told you about market funds being open-ended. Now, open-ended funds, you are of course allowed to do new investments as well, but you have to deal with the fund manager end of day. Now, because the fund manager is doing transactions with investors at the end of the day, so they want their stocks to be bought and sold ideally as close to the end of day prices as possible, so that their net asset value and their trading prices are as close to the net asset value as well, right? So the orders they like to place are those orders that, okay, they know how much new investment they're expecting, or they know how much investment they have to take out and return to clients. So they know that they have to either sell stocks or buy stocks on a particular day. What they will do is they will place orders to sell stocks or buy stocks. It's just that they will say, hey, please execute these orders close to the close of the market, just before the market closes, so the prices of the transaction are as close to the net asset value as possible, because the NAV is calculated at end of day prices. Right, stop orders. This is a little tricky, but I'm going to try and explain it to you in a really nice way, so hopefully you will be able to understand it. Now, first of all, think of a long position. Right, long position means what? Let's say, and let me change the color here a little bit. Let's say there's a stock trading in a range, right? Let's say there's a stock trading in a range. And what is that range? One sec, please. Let's say that range is between $100 and $90, right? Now, and my thesis is that, okay, I'm going to buy here, and I'm going to sell here, because what I've seen is that it's trading in a range, right? I've seen it previously, and this is my expectation, that I'm thinking that it's going to go up and I'll sell here. So what I do is I place a buy limit which gets hit and my buy is done. Then I place a sell limit and I'm hoping that it goes up and it's sold, right? But I want to manage my risk as well. So what I do is if let's say I'm wrong and instead of going up it comes down, right? So what I also want to do is I want to have something called a stop loss, right? Now the order type that I have to place is going to be called a sell limit, sell stop. This is going to be called a sell stop, which means if it comes back to 90, right, I want to sell it as well. So I want to sell it if it goes to 100, but if it comes back to 90, I want to sell it also so that my loss is limited. That is called a stop loss. Now, see, what is the difference between a sell limit and a sell stop? A sell limit basically is setting a limit on the minimum price that it will sell at. A sell stop is setting a limit at the maximum price, right? So this is what confuses people, that how can you have a sell at the limit of a maximum price? You want to sell of a minimum price, right? Ideally, you want to sell at a higher price. That's true for a limit order. But when we talk about a stop order, it works the other way around. So a sell stop will have a maximum price that if it goes below that, then you will want to sell it. Now, coming to a short position, same story, right? So let's draw our range again. So let's say there is 100 and 90, right? Oh, sorry about that. And now here, these guys, their plan is that, oh, it's going to go down. So they will borrow and sell over here. Borrow and they will sell, right? Which means they get that $100 cash. Now what they are hoping that it goes down to 90 and they will buy back over here. So what they will do, they will put a buy limit over here, right? To buy it back at 90 to return it. But if it doesn't work out and it starts going up, so here they will place something called a buy stop. Either way, they have to buy the stock back to return it, right? Either they will do a buy limit, which is the minimum price at which it is going to buy, which is 90. But they will also place a buy stop, which is the maximum price at which it is going to buy. And above that, it will quickly try to buy it back before it goes higher so that their loss is limited. So this is also a stop loss, but for a short position. This is a stop loss for a long position. So hopefully you understand now. It confuses a lot of students, but if you think about it this way, I think it's actually fairly simple. Right, in terms of clearing instructions, stock markets usually work at a T+2 settlement, which means the cash from, if you're buying a long position, your cash will be deducted today, and then after 2 days, you will receive the stock in your account, right? You want to receive it in your brokerage account, you want to receive it some other custody account, you can tell them that what is the instruction, where the final settlement has to be put in, right? So where the custody is going to be, etc., etc. So whatever are the instructions for clearing, you can give that. Right. We've talked about the difference between primary and secondary markets. Primary markets is where the first time the securities are being issued. That could be stocks, that could be bonds, right? Sold to the public. The issuer is getting the money here. Later on, what happens is that investors are buying and selling among themselves. So that is the secondary market. Now, what are examples of primary market transactions? Of course, public offerings. You can do IPOs. We'll talk about an IPO in more detail. There are stages of IPOs. So first, what happens is first you have the book building, where the issuer is going to deal with big investors, right? And then after that, you'll offer the remaining part of the issue to the retail investors. And it could also be a secondary offering. So IPO is when the first time a company is issuing its stocks. You could also have secondary offering, also called seasoned offerings. So, right, these are all examples of public offerings. Secondary or the first time, which is IPO. And this could be for bonds as well, right? So for stocks, of course, it's called initial public offering for stocks, but then you could be doing bonds as well. And an investment bank really helps you out over here. There are two ways in which the investment bank can help you out. Either the investment bank takes the responsibility. So let's say there is a company A, and they want to raise $10 billion, right? So they're selling, let's say 1 billion shares at $10 a piece. And the investment bank tells them, hey, don't worry, if nobody will buy it, we will buy all the shares. So when they're underwriting this offer, that means they're taking the responsibility that if nobody will buy it, we will buy it. But in return, if they are able to sell each share for, let's say, a higher amount, so whatever extra money comes in, that goes into the investment bank's pocket, right? So that could be a really, really interesting deal. Or they could say, oh, this extra certain fees is going to be, that depends on the negotiation, right? But investment banking can be very, very profitable business. However, of course, the risk is there, because if nobody else buys it, then if the entire issue is not sold, then the investment bank will buy the remaining securities. Best effort offering is that the investment bank says, I'm only going to do my best effort. I'm not taking the responsibility, right? Whatever is sold, I'll take a certain percentage of that as fees. Initial public offering usually is oversubscribed, and especially on the first day, and this is one of the market anomalies. We'll talk about that later in the market efficiency reading. But why do you think that is because investment bank, if it is underwriting a certain issue and they know that if nobody else will buy it, they will have to buy it, so they try to keep the original price relatively lower. And that's why what we see many times is that the IPO on its first day actually goes higher than the original price. And this is the whole point of having a conflict of interest, right? On one side, obviously they try to get the best price for their client, the issuing company, but at the same time they want a lower price, because if nobody else will buy it, they will have to buy it. So there is a conflict of interest in this entire thing, but it is what it is. Of course, IPO is the first time. If a company wants to do some more offerings, they can do seasoned or secondary offerings. Now, if you don't want to get an investment bank involved because it's too expensive, or you just want to save fees on that, then what you could do is a private placement. So you're not going out to the public, you're going out to some limited investors, right? So of course, you might not get a very high price. So usually what happens is, if you go to the public, you get a very good value. Then sophisticated investors might not give you that much of a higher price, but it's less costly than going through that whole process. Because when you go for the public offering, of course the securities laws that get involved are different, because the regulator obviously wants to protect the public, because they are not as sophisticated as the other investors, right? So since you're now going to relatively less sophisticated investors, the government is going to step in to protect them, and then the process for you is just higher. It's a very high bar of disclosure requirement for public and a much lower one for private. Right. What you could do is you could just get a bigger approval in place, right? So let's say eventually I'll have to do 100 billion. So I get an approval for 10 billion, and then later slowly I keep issuing stock as and when needed. But I get the paperwork done and put on my shelf from before. What else? Rights issues. So sometimes you want to change shares, right? In terms of you want to issue new capital, but you don't want to dilute your shareholding. So let's say I have 100% of a company's equity. If I want new money to come in, well, if it's somebody else, then my 100% will become, let's say, 90% if I'm taking new investment, right? But if I don't want to do that, or at least if I want to give my existing shareholders the right of first refusal, that if they are the ones who want to invest more, well, they can do that. If they don't want to, then they can give their right to somebody else. So the companies give a right to buy new stock to existing shareholders first, and if they don't want to do it, then they can actually sell those rights. So these rights also trade in the market. Right, very, very important. Secondary markets, obviously, if are not there, nobody is going to buy stocks in primary markets, right? Because why are you buying it in the IPO? Because you can go to the stock market and sell it to somebody later on. So it's very important that secondary markets are there. They should be liquid, right? It should be liquid, and you should easily be able to sell them. And only therefore, if that is the case, then you will be interested in buying the stock in the primary market, which means the companies who are issuing these securities will be able to get good prices for those stocks, which means if they are able to sell a stock instead of 10, if they are able to sell it for 12 and they're paying a $2 dividend, so then $2 as a percentage of 10 versus as a percentage of 12 becomes a lower cost. So from the company's perspective, they're getting 12, they have to pay 2 dividend on it, or 2 is the return they have to pay on it, which is a lower percentage of the amount they received, right? So lower cost of capital is good for the issuers. Right. What else? Secondary market and contract structures. So trading sessions, execution mechanisms, and market information systems. So let's have a look at this. First of all, call markets and continuous markets. Usually what happens is, let's say a stock market is open from 9 to 5, but this is a continuous trading session. Before the market opens, let's say from 8:45 to 9 p.m., there will be a pre-open. Now, a pre-open is not a continuous trading system. What happens is people will come in the morning at 8:45 and everybody is going to put their bid and asks. Some will put higher asks, some will put very low bids, but some might put a bid and an ask which actually matches. So at 9 p.m. the market will clear, and whichever bids and asks are matching, they will be executed. The remaining will just be cancelled. And then the continuous trading market opens, right? Then the continuous trading market opens, and then continuously people are putting bids and asks, and either they are getting executed or they're just remaining in the order book. But with the call market, what happens is everybody puts orders, they're not executed. Then before the market opens, the market is called and the market is cleared, and then the continuous trading session starts. So an interesting example over here, let's have a look. So there's Tom coming in, putting in a limit order to buy 150 shares. Now this is the order book. They want to buy. So the sellers, this is actually the other way around. The asks are written like this, right? That the market price is going up, and here the market price is going down, and these are the bids. So these are the sellers, these are the sellers, and this guy is coming in and putting an order to buy at 34, right? 150 shares. So what do you think is going to happen? Will he take out Simon and Sam? He wants to buy 150 shares at 34. What do you think is going to happen? Pause the video, think this through, and then I'll show you the solution. Yes, you're absolutely right. They're going to take out Simon and Sam because, of course, 150 shares they want to buy at 34. So these 60 will be done, these 40 will be done, and remaining 50 will still remain, and he will then become the best bid or the highest bid, which is 50 shares at 34. He'll make a new market, and he'll take partially the market as well. Right, okay. Now, there are three different types of execution mechanisms. What we've been talking about, order-driven markets, this is mostly how stock markets work, right? Your Forex works on quotes. So the big banks, they will quote, okay, I'm willing to buy pound at this much, I'm willing to sell pound at this much. So they quote the bid and ask. That's how Forex works. And then bonds, of course, there is no bond exchange. This is done through brokers and dealers. So they, of course, will do the private negotiation. Okay, you want to sell bonds, let me try and find a buyer for you, etc. Right? So quote-driven markets, this is like, for example, Forex, the big dealers, the big banks who have the inventory of these currencies, they will have a certain quote for the bid and ask, and the spread is how they make money. The lower the spread, that's liquid market. The higher the spread means illiquid market. Order driven, I think you already know about that very well. There are rules. Of course, the pricing rules you are already aware of in terms of the bid and ask and order book and everything. In terms of the order matching, so let's say there is a ask at 101, right? But there's two people who've put this. Let's say Mr. A and Mr. B. And there is somebody coming in and putting a bid of 100.01. And let's say this guy has 100 shares, this guy also has 100 shares, and the bid comes in for 150 shares. So depending on who put their order first in terms of timing, right? So if Mr. A was first, so first his shares will be sold, and then Mr. B's only 50 shares will be sold, since this order is only for 150. So that entire order will be executed. Mr. A will sell all of his shares, but Mr. B will still have 50 shares remaining because he was late. Brokered markets usually used for bonds, and of course real estate as well. Everybody knows real estate brokers, right? But of course for fixed income securities, we also have brokers who will try and match a buyer with a seller. In terms of market information systems, a lot of markets tell you the trade, the order book is disclosed even before the orders are executed, right? So that's very good. And of course the trade after the trade is done is there. So in terms of dark pools, yes, you will find out after the trade is done that this trading was done. But in the dark pool, you cannot see the order book. So again, different market information systems are there. In a lit venue, right? So you have lit venues. In a lit venue like New York Stock Exchange, you will see both post and pre-trade, but in a dark pool you will not see the pre-trade, only post-trade you will be able to see. All right, guys, let's take a break. We'll come back and then jump into what makes a well-functioning financial system.